George, things got very interesting very quickly in the bond market, didn't it? The question I've been asking over the last 24 hours is, what is the dominant factor underpinning this move that we've seen in the last couple of days? What is it, George?
Hey, good morning, John. Listen, I've been warning for a while. When the belly of the curve starts to swing, and it could be swinging from Japan all the way to the U.S., that 5 to 10 year part of the curve is the most sensitive part for all parts of the yield curve, as well as for risk assets. And so, we're experiencing a wrecking ball from supply concerns, from concerns around foreign buying that's going to slow down, and I think all that's kind of culminating after an environment where rates have been staying under Fed funds for a long time, and that's been the saving grace for all markets, that we've had a very rich 5 to 10 year part of the curve.
How important is Japan's contribution to this volatility, if we can call it that, George, that we've witnessed over the last week?
Look, I think it's hard to attribute exactly. It's the impetus, it's the catalyst, it's the concern about will Japan start stepping back from buying U.S. Treasuries. But more importantly, it's a global rise in rates. Japan was the last mover of moving away from ultra accommodative policy. It's the early days for this.
So the question I asked George of Ira Jersey of Bloomberg is whether this establishes a new floor for global yields, or if we've got to think about a new ceiling. Which one is it, George?
I think it's a floor, because I think we're also at the same time trying to figure out when is the actual, like the neutral rate for the U.S. 10-year rate as well, with Fed funds, at 5+ rates. If we get a Fed decline in the future in Fed cuts, the Fed's not going to go to zero again. So I think we're trying to figure out, is the floor 3? And I think that this is starting helping that process.
That was what was interesting about the call from Mike Gapin of Bank of America. He made the call in the last 24 hours to drop his recession forecast. But if you go into the note, I think the real call, and Mike says this himself in the research, George, the main difference between our new forecast and prior forecasts is in the pace of rate cuts that they're calling for. They think we get another hike from the Federal Reserve, but ultimately when they cut, it'll be in 25 basis point reductions for a total of 75 next year and 100 in 2025. Now, that's 175 altogether. And if you go to 575 and you come back down, he's thinking about maybe 4, George, maybe 4% on Fed funds in the next cutting cycle. George, do you think that's been well priced, well understood by others?
Look, the bond market has been skeptical, and we've discussed this a number of times before. That's probably a little bit more than what I would expect, or less than I expect. I think eventually, what the Fed has done, these long and variable lags, they're in delay mode. They're not necessarily dead. The transmission mechanism of the Fed is taking much longer, and people now are starting to believe that we can handle these higher rates. That's not what I'm saying. My point is that the discounting of the belly of the curve, that's what matters most, and it's been the most mispriced throughout this whole process. So if we get the 10-year staying above 4% for longer, that matters more than where the Fed goes.
George, reasons to believe we can take out last year's highs on the 10-year?
Oh, absolutely. I think now that we broke that double 408 tight top on the 10-year and today's price action, a lot of this is setting up for next week's auctions, which are going to be brand new 10-years, which are the even larger 10-years after the auction announcements and the refunding. We're going to, the market's going to probably discount as much as they can to try to get a higher coupon, and then we'll take it from there.